Here's a truth most traders never want to face. Confidence has destroyed more accounts than fear ever did. Every new trader thinks the goal is to trade with confidence, to move with conviction, to believe in their analysis. They search for strategies, indicators, gurus, all to feel certain. But Jesse Livermore knew better. He once said, "The market is designed to fool most of the people, most of the time." He wasn't talking about chart patterns or manipulation. He was talking about psychology, the inner war between illusion and truth. Confidence without structure, he learned, is just ego dressed up as certainty. It makes you bold when you should be cautious and frozen when you should act. It's not real confidence, it's hope. And hope in markets is fatal. Picture this. A trader doubles his account in a week. His setups look flawless, his entries precise, his profits smooth. He feels invincible. So he starts increasing his position size, skipping confirmation, ignoring stop losses. The same trades that once made him money begin to reverse. He holds, convinced it will turn. It doesn't. Within days, his balance collapses. What changed? Not the market, not the method, just the belief that he couldn't be wrong. That's the trap confidence detached from respect for risk. The professional sees the same trade differently. He knows every setup begins as a coin flip, 50 over 50, heads or tails, profit or loss. There's no edge until discipline creates it. Livermore's great insight was that trading isn't about predicting, it's about balancing. He treated confidence and risk as equal weights on a scale. One without the other breaks equilibrium. Too much confidence, and you overtrade. Too much fear, and you never pull the trigger. He called this internal equilibrium the balance of mind, and it became the silent foundation of his entire approach. This is the essence of what I call the 50 over 50 rule, an understanding that you must hold risk and conviction in perfect tension. Amateurs chase certainty, professionals chase control. The difference isn't what they believe, it's how they manage what they can't know. Confidence in Livermore's world wasn't bravado. It was composure earned through preparation. The professional knows the worst outcome before the trade begins. He sizes accordingly. He sets his stop. He defines his risk. Because when you accept uncertainty before entry, you no longer need emotional certainty afterward. That's the paradox most traders never grasp. The strongest confidence comes not from knowing you'll win, but from knowing you'll survive if you don't. The amateur trades to prove he's right. The professional trades to preserve the ability to try again. Livermore once described the market as a great equalizer of emotions. Every tick tests your identity. Are you the gambler chasing revenge, or the operator executing process? The professional never asks the market for validation. He uses it as a mirror. When he feels excitement, he sizes down. When he feels fear, he observes rather than reacts. He knows that real confidence is quiet, measured by how little he needs to speak about it. Every decision must pass through that balance. Is this action disciplined, or is it ego disguised as skill? That's the hidden genius of Livermore's philosophy. He viewed trading as a psychological equilibrium, not an analytical puzzle. The numbers mattered, yes, but only as extensions of his mental framework. He didn't aim to predict the market. He aimed to align with it. The 50 over 50 mindset made him immune to the emotional chaos that destroys most traders. It kept him from falling in love with his positions or panicking out of them too early. He understood that every moment in the market has equal potential for profit or loss. The goal isn't to avoid one and capture the other, it's to act so consistently that over hundreds of trades, your process tilts, those odds just slightly in your favor. That small tilt discipline over impulse is the true edge. But there's another layer to this rule, one few talk about. Livermore didn't treat balance as passivity. He wasn't neutral in the face of risk. He was deliberate. Balance doesn't mean hesitation. It means harmony between caution and aggression. The amateur waits for perfect clarity, then hesitates when it comes. The professional accepts that clarity never arrives, so he acts decisively when the market confirms, not predicts. The 50 over 50 mindset isn't a coin toss. It's the recognition that uncertainty is constant, and control comes only from your reaction to it. If you asked Livermore what confidence meant, he might have said this: "It's not believing you'll be right. It's knowing exactly what you'll do when you're wrong." That distinction changes everything. Most traders equate confidence with certainty. They think they need conviction to enter. But conviction built on illusion leads to ruin. Professionals construct conviction from process, risk small, plan exits, measure reactions. It's mechanical, not emotional. That's why Livermore could sit out entire weeks, watching markets without making a move. He understood that waiting was part of his edge. When nothing aligns, doing nothing is a trade. That's the hidden discipline of the 50/50 rule. Each decision whether to enter, hold, or stand aside carries risk. The professional measures it not in dollars, but in clarity. Acting without clarity is risk. Waiting with purpose is control. That's how confidence becomes structure instead of emotion. Livermore didn't win because he was fearless. He won because his fear was organized. He had rules to protect him from himself. He knew his capital was his lifeline, his mental equilibrium his weapon. When confidence and risk balanced perfectly, he could execute with total detachment. This is why the average trader never makes it past the learning curve. They believe mastery comes from knowing more. In truth, it comes from feeling less. Less excitement, less panic, less need to prove anything. They think professionals have stronger confidence. In reality, professionals have stronger boundaries. They stop where amateurs start pressing harder. They protect confidence by capping risk. The amateur treats confidence as fuel. The professional treats it as a signal. When confidence spikes beyond logic, that's the moment to pause. The market punishes those who confuse emotion for edge. Livermore used to say, "The big money is not in the buying and the selling, but in the waiting." That single sentence summarizes the 50/50 rule in motion. The waiting builds discipline. The discipline builds structure. And the structure builds true confidence. Not the shaky, adrenaline-fueled kind that vanishes after a loss, but the quiet strength that endures. When you learn to see confidence as the byproduct of process, not the cause of it, you stop swinging between extremes. You stop chasing certainty, and you start cultivating balance. Imagine two traders watching the same setup. One feels the urge to act immediately. He fears missing out, so he jumps. The other waits, measures, calculates his exposure. The price breaks his way. He adds gradually, protecting downside, while scaling into strength. Both make money at first, but weeks later, when volatility shifts, only one survives: the one who treated confidence as earned, not assumed. Livermore's 50/50 rule separates these two identities forever. So, what does balance look like in practice? It's not mathematical symmetry. It's behavioral equilibrium. You don't eliminate emotion. You regulate it. You don't eliminate uncertainty. You respect it. Every trade becomes an expression of that internal harmony. Risk defines boundaries. Confidence fuels execution. Without risk, you freeze. Without confidence, you crumble. The art lies in keeping both alive without letting either dominate. That's the deeper secret behind Livermore's success. His so-called intuition wasn't mystical. It was disciplined observation forged over time. He had internalized the 50/50 mindset so deeply that his reactions became automatic. He didn't need to feel confident. He was confident because his method handled what his emotions couldn't. When balance becomes instinct, performance becomes natural. The 50/50 rule is the antidote to modern trading noise. Algorithms, social media, and constant data tempt traders to overthink. But the professional's real weapon remains simplicity. Measure, wait, act, review. Confidence is the outcome of those repetitions. Livermore mastered that rhythm long before computers. That's why his lessons remain timeless. Markets evolve, but human psychology doesn't. The same greed, fear, and overconfidence that ruined traders in 1907 still ruin them today. In the end, the brutal truth about confidence is this: it's not a feeling you chase, it's a condition you earn through structure. The amateur builds belief on results, the professional builds it on routine. One seeks to be right, the other seeks to endure. The first burns bright and fast, the second survives long enough to let probabilities work. And that survival is the only real confidence the market ever rewards. Livermore's 50 over 50 rule reminds us that trading isn't a test of prediction, it's a test of balance. Every decision is a scale, risk on one side, confidence on the other. When the two align, you act. When they don't, you wait. That's the quiet discipline behind every professional move. It's also the foundation for what comes next, because once you understand that balance begins in your sizing, you unlock the next level of control. As Livermore said in his own words, "It was never my thinking that made the big money. It was always my sitting. And that sitting, that balance between risk and confidence, begins with one principle above all others. Position size reveals character." Livermore once said, "The average man doesn't wish to be told that it is a bull or bear market. What he desires is to be told specifically which particular stock to buy or sell." That simple observation cuts to the heart of why most traders fail. They seek direction rather than understanding exposure. Amateurs chase certainty in a single number or recommendation, but professionals know the real battle is in how much you commit, not where you commit it. Your position size is your psychological mirror. It reveals more about your temperament than any market prediction ever could. When a trader trades too big, every tick against him feels like a personal attack. Every small loss triggers panic. Every slight gain triggers greed. You are no longer trading the market, you are trading your own anxiety. And anxiety always costs more than the market ever will. Consider this scenario. A trader identifies a setup and risks 10% of his account. The trade moves slightly against him, and panic sets in. He cuts early not because the setup failed, but because his emotions demanded action. Then, believing he can recover, he re-enters with a larger size, over-leverages, and turns a small drawdown into a catastrophic blow-up. That is the amateur's path. Trading beliefs rather than probabilities. Trading ego rather than structure. Livermore never fell into that trap. He treated size as a tool, not a declaration. He scaled into strength, added incrementally when confirmation appeared, and reduced exposure when signals wavered. Size became a thermostat. Increase when the market aligned with your thesis. Decrease when it contradicted it. The professional never trades to prove they are right. They trade to test whether they are. That is balance, and it is the essence of the 50 over 50 rule. There's a maxim that should be tattooed on every trader's mind. Size, small enough to survive, large enough to matter. It's deceptively simple, but it carries the weight of decades of failure and triumph. When applied correctly, it preserves confidence. You can act decisively because you know your exposure won't destroy you. You maintain emotional clarity even as the market tests you. But here's the twist. Even perfect sizing can't protect you if patience fails. Waiting is as much a position as any trade. The professional must learn to be comfortable with inactivity, to let the market confirm the thesis rather than forcing it into existence. Most traders see inactivity as a failure, but Livermore knew the truth. Inactivity is often the highest form of control. He called it sitting tight, observing the tape, studying volume and momentum, waiting for the pivotal point. Amateurs see opportunities everywhere, acting on every twitch in price, convinced that movement equals progress. They enter too early, add too fast, and exit too late. Professionals know that market noise is a test, and the true edge lies in filtering it. Position size allows the professional to survive these periods of observation without stress, without emotional degradation. It is a tool for longevity, a buffer that protects both capital and mindset. Size small, yes, but observe big. Wait for clarity, let patterns evolve, and act only when confirmation validates the thesis. That is the disciplined approach that separates enduring traders from those who flame out in months. Scaling is more than math, it is psychology. Each addition to a position carries a psychological weight, and Livermore understood that. When he saw the tape confirm strength, he added modestly, reinforcing both profit potential and confidence. When strength waned, he trimmed, protecting both capital and mindset. This incremental approach allows a trader to maintain balance, to experience gains without emotional overextension, to see losses without panic. Each decision becomes a reflection of internal equilibrium rather than a reaction to external chaos. Position size, therefore, is not just capital allocation. It is emotional regulation. A small, controlled exposure keeps fear manageable. A measured increase lets confidence grow organically. Too much of either, and the delicate balance shatters. It's not just about adding or trimming positions, it's about respecting the market's tempo. The professional reads price action, studies volume, interprets momentum, and uses size as feedback. If a trade moves favorably with low risk, the position can grow. If the market hesitates or turns, the position shrinks. It's a dance, a continuous dialogue between trader and market. Amateurs act without listening, overpowering the rhythm of opportunity with noise and ego. Professionals act with restraint, allowing size to amplify confirmation rather than emotion. Every adjustment becomes an experiment. Does the market confirm my thesis, or does it challenge it? The answer dictates the next step, not desire or fear. Even when the mechanical side of sizing is mastered, patience will be tested. Waiting is not passive. It is an active strategy. The market does not operate on your schedule, and the professional understands that forcing trades is the fastest route to ruin. Inactivity allows the market to show its intentions clearly, letting patterns emerge, volume validate moves, and pivotal points reveal themselves. Livermore spent hours, sometimes days, sitting at the tape, making no moves but observing everything. The professional's edge is built on these periods of observation. By contrast, the amateur mistakes movement for action, constantly adjusting size out of fear or greed, never letting the market speak. Another lesson emerges from perfect sizing: emotional clarity. When exposure is correctly calibrated, a trader can observe without panic, respond without impulsivity, and execute with discipline. Over-leveraged positions distort perception, heighten stress, and induce irrational decisions. Proper size preserves both financial capital and psychological capital, ensuring that the trader can continue to operate even when trades turn against them. Survival is as important as profit, and size is the instrument that allows both. Position sizing is also a mirror for discipline. It reveals where traders are weak, impatient, or overconfident. If you constantly find yourself over-leveraging, cutting early, or adding too aggressively, your size exposes the flaws in your character. The market doesn't punish lazily. It magnifies internal imbalance. By respecting size as a reflection of psychology, the professional converts what could be a vulnerability into a strength. It becomes a measure of control, an active part of risk management, and a test of emotional fortitude. Scaling with confirmation is another key principle. Every increase in position size should follow a clear signal: volume spikes, trend continuation, or breakout validation. Each reduction should respond to hesitation or reversal. This incremental approach allows the trader to harness momentum without surrendering control. It's a system that translates observation into action and action into survival. The amateur ignores confirmation, forcing size based on hope or impulsive confidence, and pays the ultimate price. Discipline in size creates consistency, and consistency compounds over time. The professional does not need to be right on every trade. He needs to survive to let the probabilities unfold. A small account managed with discipline can grow steadily, while a large account handled recklessly can vanish overnight. Position size is the ultimate equalizer. It protects, informs, and guides. It separates amateurs from professionals, ego from logic, fear from reason. Even with perfect sizing, the psychological battle continues. Patience, observation, and timing remain vital. The professional's ability to remain calm, measured, and aligned with the market is amplified by correct sizing. Each position is a conversation between confidence and restraint, a tangible expression of the 50 over 50 principle in action. Too large, and emotion dominates. Too small, and opportunity slips away. Mastery lies in balance, in letting size and observation work together. Finally, position size is not a static rule. It is a dynamic reflection of market conditions and personal psychology. It demands constant evaluation, adjustment, and awareness. The professional constantly asks, is my exposure appropriate? Am I respecting the market's voice? Am I acting out of clarity or compulsion? Each trade becomes a practice in self-mastery. The amateur acts without these questions, blindly following impulse and desire. The professional, guided by the 50 over 50 principle, uses size as both shield and lever, calibrating risk, reinforcing confidence, and preserving the ability to act when true opportunity arises. Position size reveals character because it exposes fear, greed, discipline, and patience all at once. It is the measure of your inner equilibrium, the gauge of your professional maturity, and the first true test of your adherence to Livermore's 50 over 50 rule. And yet, as essential as size is, it is only part of the equation. The next principle extends this balance, understanding that waiting itself is a position, and that timing and patience are as critical as dollars committed. Without patience, even perfect sizing cannot prevent ruin. The next lesson, the art of sitting tight and observing, will reveal how professionals turn waiting into power, transforming potential inertia into disciplined advantage. In markets, boredom kills more accounts than volatility ever will. Most traders underestimate the silent threat of inactivity, thinking that the absence of movement equals stagnation. But Jesse Livermore understood that waiting wasn't wasted time, it was the cost of precision. He called it being right and sitting tight. It was a discipline that required more courage than any quick trade, because it forced him to confront the quiet uncertainty of the market. Most traders cannot sit. They mistake activity for control, believing that doing something even poorly is better than doing nothing. Their need for action masquerades as discipline, but it is often just fear or impatience in disguise. Here is the paradox. The very moment you feel the urge to trade, that is often your signal not to. When your hands twitch at every tick, when your eyes flinch at every price movement, the market is testing you. Professionals understand this. They see the tape like the tide, not as a call to arms. They do not chase every wave, nor do they panic when it surges against them. They wait for the pullback, the moment when the market exposes direction clearly. Amateurs, on the other hand, surf every ripple, drowning in the noise and losing both capital and confidence. Livermore spent days, sometimes weeks, doing nothing but watching the tape, observing how volume accumulated, how momentum shifted, and how patterns hinted at forthcoming pivotal points. Clarity, he knew, only appears when the market tips its hand. The amateur asks, "What should I do next?" The professional asks, "What is the market telling me right now?" That simple shift in perspective transforms waiting into action. Waiting is not passivity, it is a position in itself, a defensive and strategic stance that preserves capital and sharpens judgment. Waiting is a position one that pays in clarity. By doing less, you filter better. By filtering better, you act faster when the true opportunity arises. Impatience, conversely, replaces skill with stimulation, forcing traders into trades that satisfy the mind, but not the market. Patience builds confidence because it removes noise. Impatience destroys it because it invites chaos. Yet, even waiting has its limits. The 50 over 50 balance deepens here. Waiting too long can become fear, a covert form of avoidance. How do you distinguish disciplined observation from paralysis? Livermore had a rule for this too. The market will provide unmistakable signals, but you must know how to recognize them. A professional calibrates patience with engagement. Too little patience, and the trader chases. Too much, and opportunity slips away. Observing without purpose is no different than acting without strategy. Think of the market as a tide that ebbs and flows according to forces beyond comprehension. Professionals wait for the pullback, the alignment of confirmation and risk, the moment when probabilities favor them. Amateurs trade every motion, mistaking turbulence for opportunity. The professional's edge lies in restraint, in allowing clarity to accumulate over time, in knowing that the cost of waiting is insignificant compared to the cost of acting prematurely. Each pause allows for observation, each moment of stillness a chance to understand volume, trend, and momentum. Livermore mastered this art. He did not fear inactivity because he trusted process. And he trusted the process because he had a system for evaluating when to act and when to remain still. Patience in trading is a test of identity. Amateurs define themselves by movement. Professionals define themselves by decision quality. Each second spent sitting tight is not empty. It is an investment in clarity. The market whispers, hints, and the professional listens. Patterns emerge slowly, not in bursts. Momentum confirms itself over time. The trader who can sit, observe, and calculate without acting impulsively builds a mental edge that rivals any analytical strategy. Waiting becomes a weapon because it creates a context in which every future action is informed and decisive. Yet this principle carries a trap. Waiting must be purposeful. Idle observation without criteria leads to hesitation and missed opportunities. Livermore called it the art of timed engagement. You observe, you interpret, you prepare, but you only act when the market aligns with your thesis. That alignment, the pivotal point, is what transforms a passive stance into an active edge. Without it, waiting decays into fear-driven avoidance. Too many traders fail because they do not recognize this boundary. They wait for perfection that never comes, confusing patience with procrastination. The professional's patience is reinforced by position size and risk control. Even when the opportunity is present, exposure is never reckless. Waiting and sizing work together as a feedback loop. Time filters noise, and size preserves balance. Each moment of observation is a position that accumulates insight, ensuring that when entry occurs, it occurs with maximum clarity and minimum emotional compromise. In contrast, amateurs overreact, entering early and sizing irresponsibly, creating chaos for themselves. Waiting also tests emotional equilibrium. The mind craves action. It fears doing nothing. Yet the professional recognizes that each tick, hesitation, is an opportunity for reflection. It is a moment to review context, to analyze volume, to measure the strength of trends, and to ensure that any forthcoming engagement is not reactive. This discipline builds confidence. By mastering waiting, traders internalize the 50/50 rule. They balance risk and conviction, confidence and restraint, patience and action. The skill of waiting, sitting tight, observing the tide, allowing the market to reveal itself, is perhaps the ultimate demonstration of professional identity. Finally, waiting refines judgment. Every hour spent observing without acting teaches the trader what is noise and what is signal. Each observation informs future decisions, calibrates risk, and hones the understanding of pivotal points. The professional does not measure success by trades executed but by clarity earned. Waiting is a position because it shapes outcomes before capital is committed. It transforms uncertainty into insight, indecision into preparation, and potential loss into managed risk. Amateurs never see this. They trade because they must, not because they are ready. Professionals trade because the market gives them permission. Livermore's lesson is timeless. Do not fear inactivity. Embrace it as a tool. Let patience accumulate insight. Let observation build confidence. Every trade executed without waiting is a potential error. Every trade executed after waiting is a calculated decision. The 50/50 rule manifests here. Risk remains defined. Confidence remains disciplined. and timing becomes your ally rather than your enemy. Waiting is more than an action. It is a position, a strategy, and a mindset. Those who master it survive and thrive. Those who ignore it falter and fade. Understanding when to wait, how long to wait, and what to observe is as crucial as knowing how to act. The power of waiting turns inertia into opportunity, hesitation into advantage, and patience into profit. Livermore called it the pivotal point, that precise moment when the market confirms your thesis. It is not a guess, a hunch, or an instinctive leap. It is the culmination of observation, patience, and disciplined sizing. He didn't enter trades because he wanted them to work. He waited until the market itself delivered the proof. The pivotal point is not about prediction. It is about confirmation. When price action breaks a key level with volume and follows through, it is not luck. It is the alignment of probability, timing, and observation. The market speaks, and the professional listens. The amateur hears noise and reacts. Professionals allow patience to accumulate data, not doubt. They construct an evidence-based view where a seemingly even 50/50 setup is transformed into a 70/30 probability through careful observation and confirmation. Consider this. A trader spots a stock consolidating near its highs. The novice sees opportunity and jumps in preemptively, believing he is demonstrating conviction. Often, this leap is punished. The professional, in contrast, watches. He observes volume, checks momentum, measures the alignment of trend across multiple timeframes. When the breakout occurs and volume confirms, he enters small, testing the strength. As the move proves itself, he pyramids carefully, scaling exposure with the market's validation rather than his own desire. This is confidence built on structure, not emotion. Each addition is deliberate, each reduction protective. The maxim that guides this process is simple but profound. Patience without trigger is paralysis. Trigger without patience is suicide. In these words, Livermore codifies the 50/50 rule in action. Your edge appears only when timing and size converge, when observation meets opportunity. The pivotal point is where patience and action intersect. Waiting alone without confirmation is idle. Acting without confirmation is reckless. Most traders fail because they confuse impatience for insight or anticipation for intelligence. They enter early, cut late, or chase trends that have already expended their momentum. Professionals understand that each trade is a probability play, not a wager. Confidence is not the result of feeling right. It is the result of evidence, alignment, and repeated validation. By waiting for the pivotal point, the trader ensures that risk is defined and probability is in his favor. The market's confirmation transforms uncertainty into a calculated opportunity. Control is the final piece of this puzzle. And it is not control over the market that is impossible, but control over oneself. The professional cannot eliminate risk. He can only manage it. He cannot predict every move. He can only respond to the data the market provides. Emotional control allows patience to function, enables sizing discipline to persist, and allows entry at the pivotal point without fear or greed distorting judgment. Livermore's philosophy reaches its core here. The market tests character as much as strategy. Success comes from alignment between mind and market, not from guessing or hoping. The amateur leaps ahead of confirmation because he confuses action with mastery. He adds risk because he seeks validation. He cuts positions because he fears loss. The professional sees the same environment but acts differently. He allows the market to define his moves. Each trade is deliberate. Each decision filtered through observation. Each addition or reduction measured against evidence. That is the pivotal point in practice. A moment of clarity where conviction is justified, not assumed. Where confidence is earned, not imagined. Volume is one of the greatest teachers at this stage. Breakouts without confirmation of volume are traps, whispers of movement rather than proof of direction. Professionals wait for the tape to validate their thesis. Price and volume must align to create the asymmetric odds necessary for disciplined engagement. By waiting for these confirmations, traders convert uncertainty into a manageable risk, allowing size to be adjusted with confidence. The result is not reckless gain but structured advantage. Confidence is no longer emotion, it is probability. The pivotal point transforms patience into power, observation into edge, and calm into action. The timing of the pivotal point is nuanced. It is rarely a single candle, a single number, or an obvious breakout. It emerges over hours, days, and sometimes weeks, as patterns coalesce, volume supports movement, and momentum confirms direction. The professional develops the skill to recognize these subtleties, filtering market noise from actionable information. Each instance becomes a test of discipline. Will you act when the probability favors you, or will you succumb to impatience and ego? Acting prematurely is costly. Waiting too long risks opportunity. The pivotal point exists in the balance between these extremes, where structured confidence meets precise execution. Even experienced traders can misread the pivotal point if emotional control falters. Fear can delay entry, greed can push over commitment, and ego can force early participation. Livermore understood that mastery of the pivotal point required mastery of self. The market will not conform to your desires. Your task is to align with its signals. Confidence without recklessness arises from this alignment. The professional acts only when the setup validates itself through market behavior, not when instinct dictates. The amateur acts for validation, excitement, or impulse, often paying a steep price. The pivotal point also illustrates the marriage of patience and sizing. Entry without proper exposure management undermines even perfect timing. Professionals use small initial positions to test the setup and scale cautiously as confirmation unfolds. Each increment reflects evidence, not emotion. By pyramiding in alignment with the market, they amplify gains without inviting uncontrolled risk. Conversely, premature commitment magnifies losses, erodes confidence, and destabilizes the mental framework. Discipline in size and timing transforms potential volatility into a controlled advantage. Pattern recognition is not sufficient without confirmation. Price can flirt with breakout levels, and volume can spike without follow-through. The professional integrates these signals into a coherent thesis. Observation becomes actionable intelligence only when the market validates it. Waiting allows probability to shift from ambiguous 50 over 50 to favorable odds, from risk-laden guesswork to informed decision-making. The pivotal point is where analysis, patience, and execution converge, creating an opportunity that respects risk while offering potential reward. Ultimately, the pivotal point embodies Livermore's core lesson. Confidence is justified only through evidence. Action without patience is reckless. Patience without action is paralysis. When timing, sizing, and confirmation converge, the market gives permission to act, and the professional moves decisively. Control over self, discipline in exposure, and mastery of observation make this possible. The amateur confuses impulse with insight. The professional cultivates alignment, probability, and timing. The pivotal point is the manifestation of the 50 over 50 rule. In practice, a disciplined framework where confidence meets opportunity, restraint meets execution, and observation meets action. Mastery here is not about being right. It is about acting when the market proves the path forward. Jesse Livermore's greatest trades did not come from clever predictions or technical brilliance. They came from emotional balance. He once said, "The game taught me the game," and he meant every win, every loss, every mistake was tuition. Each trade, whether successful or not, was feedback, a lesson in patience, discipline, and self-mastery. The 50 over 50 rule is not fundamentally about the market. It is about you. It is about understanding that the balance between risk and confidence determines everything. When you maintain that equilibrium, emotion loses its grip. You stop chasing trades to prove you are right. You stop fearing losses. You stop letting greed or panic dictate position size or timing. Instead, you start listening to the market rather than reacting to your impulses. Amateurs seek emotional certainty. They want to feel sure, to experience the comfort of knowing they will be correct, and they often tie their self-esteem to outcomes. Professionals, on the other hand, seek emotional neutrality. They do not need to feel right, they need to follow the process, and the process carries them through uncertainty. The paradox most traders fail to master is simple yet profound. You can't control outcomes, only inputs, and inputs compound. Focus on what you can manage: position size, timing, observation, and process, and the results, over time, will reflect disciplined execution rather than fluctuating emotions. Livermore did not build his fortune by being right on every trade. He built it by being consistent. Small losses were controlled with strict stops, and gains were allowed to run only when the market confirmed strength. He pyramided into winners, trimmed into weakness, and never let desire dictate size. His edge was not in prediction, it was in adherence to process. That is what mastery looks like: equilibrium between confidence and caution, between aggression and restraint, between patience and action. Here is the protocol every professional trader must internalize: size small, wait long, act only at pivotal points, cut losses fast, letting strength prove itself. Own your process, not your outcome. These steps form a repeatable framework, a protective skeleton around the chaos of markets. It is how professionals survive decades, weathering volatility and uncertainty without surrendering to fear or greed. Execution becomes mechanical, not emotional. Decision-making becomes disciplined, not reactive. By following this rhythm, confidence is built on evidence, risk is bounded, and opportunity is leveraged intelligently. Cut losses fast, size small, wait, observe, execute, repeat. This simple yet profound mantra encapsulates decades of wisdom. When applied consistently, it transforms volatility into advantage and uncertainty into clarity. It preserves capital, sharpens judgment, and creates compounding opportunity over time. Emotional equilibrium becomes a tangible skill, not an abstract concept. Confidence emerges from process, not from hope, and fear is constrained by clear boundaries. In the end, the 50/50 rule is not a number, it is a mindset. It is the ongoing calibration of self in the face of markets that cannot be controlled. It is the practice of balancing risk with confidence, patience with action, observation with decisiveness. Mastery is not perfection, it is resilience and consistency. It is surviving losses and letting probability work in your nother's best favor. Every professional trader, at the highest level, operates with this equilibrium. They act without ego, manage without fear, and make decisions with clarity that only comes from decades of disciplined repetition. When you internalize this, trading stops being a roller coaster of emotion. You are no longer defined by individual wins or losses, but by your adherence to the process. You no longer chase validation, you seek alignment. You measure your actions not by outcomes, but by how faithfully you follow your principles. That is the ultimate expression of the 50/50 rule. It is the fusion of discipline, patience, and clarity. It is confidence without recklessness. It is risk without panic. It is waiting without hesitation. And when practiced consistently, it becomes instinct, a mindset that allows you to endure, adapt, and profit where amateurs falter. The 5 steps: size small, wait long, act at pivotal points, cut fast, and own your process are the pillars of professional trading. They encapsulate everything Livermore learned over decades. They teach that mastery is emotional equilibrium, that balance between risk and confidence determines survival, And that process is the only true path to consistent results. When executed, they convert volatility into opportunity, fear into discipline, and uncertainty into a repeatable advantage. Traders who understand this mindset are no longer at the mercy of the market. They operate within it, with clarity, control, and confidence. Ultimately, the 50 over 50 rule is not about winning every trade. It is about winning over time. It is a lifelong practice of balancing inputs, respecting risk, and cultivating emotional stability. Confidence emerges naturally when decisions are informed, size is controlled, and timing is precise. The market becomes a partner in your process rather than an adversary, and your results reflect method, not emotion. The 50 over 50 mindset is the foundation upon which professional longevity is built. It is the lens through which all market activity should be evaluated. It teaches that survival is the prerequisite for success, that patience compounds, and that discipline is both armor and weapon. Cut losses fast, size small, wait, observe, execute, repeat. Internalize these principles, and trading transforms from a battle of impulses to a practice of mastery. Emotional equilibrium is not abstract. It is the operating system of the professional trader. When applied consistently, it ensures that risk is managed, confidence is grounded, and opportunities are executed with precision. The 50 over 50 rule is no longer a principle to learn, it becomes a lens through which every decision is filtered. And that lens defines the professional, not by luck, but by discipline, clarity, and mastery over self.